I think it's useful to maybe provide an example. This would certainly help me to sort through some of the details here. I remember back in the mid-noughts that many European banks were underwriting mortgages in foreign currencies. Like there's lots of mortgages underwritten in francs, in euros, and in dollars for in countries that were not using those currencies as their as their dominant currency, right? So I was curious, like how does a small European bank, which presumably has almost no U.S. dollar deposits, underwrite U.S. dollar mortgages? And presumably the answer is because they're able to create this liability on their balance sheet and use derivatives with other banks that are members of this club to swap out their dollar risk, right? So they're issuing dollar credit, they're swapping out their dollar risk ostensibly through derivatives. So they've got another counterparty that they're facing their dollar liabilities. Several, right?
Yes.
And when markets operate normally, those private swap lines provide sufficient equilibrium to the Eurodollar system between banks. What happened in 2007 that severed that private system and required the Fed to intervene the way they did?
Well, let's take a really simple example. Let's take a bank in Germany, just any bank, one of any number of German banks that people maybe noticed that were being nationalized in 2008 and wondering how a U.S. subprime mortgage crisis would lead to small banks or regional banks in Germany being nationalized by the German government. The answer is, as long as these banks had balance sheet capacity to take on some kind of credit, they could extend that balance sheet capacity through these Eurodollar money dealers to any part of the rest of the world. Because remember, the Eurodollar is a global reserve currency. Therefore, it offers a menu of options. You want to invest because you think the risk-adjusted returns are good in Asia? Let's swap into dollars and then let's go into Asia. And so what happened was largely, so these dealer banks would create these mortgage assets in, say, the United States, because let's stick with subprime mortgages because that's a good place to start. So the dealer banks would contact and contract with wholesalers who would create this pool of mortgages, which then the dealers would securitize into saleable securities, so that you would have essentially mortgage bonds that were somewhat liquid. So then you could contract, the dealer then would sell the rights or sell the bond itself or fund the bond on behalf of the German bank. So the German bank would own title on the mortgage bond, but would actually fund the portfolio of securities through the repo market, either by pledging that mortgage bond in repo or by transforming that mortgage bond into collateral for collateral swap, which was kind of common back then too, which meant that if you wanted to do the collateral for collateral swap, which means you have kind of a crappy, junky mortgage bond that doesn't get the most favorable terms, maybe a high haircut, dealers kind of look funny at it. They don't want to lend necessarily because it's kind of a crappy junk bond. Well, you just go to AIG's FP division and borrow a U.S. Treasury that AIP has borrowed from its insurance company portfolio, which has tons of treasuries just laying around in these portfolios. You pay AIG a small spread. You borrow that treasury. You post the treasury in the repo market to borrow the necessary funds that then is funding this crappy mortgage bond. And so you have this multi-leg transaction that spans all sorts of boundaries and physical boundaries, financial boundaries, regulatory boundaries, because you got treasuries that have been repledged and reused and reborrowed several times from a regulated insurance company to suddenly being used in repo in some small bank in Germany. And there's U.S. dollar funding involved in the repo market that's global. It could be tri-party repo, it could be bilateral bespoke, it could be any number of things. But the point of the matter is the Eurodollar system had evolved that if you were just a regional bank in Germany and you wanted to participate in something that you thought looked good, there was an easy way to do it, or what seemed like an easy and dependable way to do it. So we fast forward to 2007, August 9th, 2007 to be specific, and suddenly some questions about liquidity in these mortgage bonds, which you've taken this mortgage bond that this dealer has sold you. You're not posting as collateral in the repo market, but you are posting it as collateral for that swap to the U.S. Treasury that you borrowed from AIG. Now, AIG says, I don't really like this mortgage bond that you're using as collateral to borrow my Treasury. I need you to put up a little bit more collateral of the same kind, or I'm not gonna do this swap with you anymore. And once AIG says I need more collateral, you don't really have any because you're leveraged to the max. What do you do at that point? Well, you either have to find a treasury that you can borrow from somewhere else, and the price on treasuries, the price on borrowing treasuries is going up and up and up, because as you're having problem with your crap mortgage bonds, everybody else is too. So as the price of continuing this sort of jerry-rigged game of funding and credit and balance sheet mechanics, as it starts to go a little bit awry, nobody had the margin to step in and stop it. Because on an individual basis, I don't have a treasury, all I have is this crap mortgage bond. So what happens if I lose my ability to swap into treasuries? I'm cut off from repo. At least I'm partially cut off from repo. I can't fund this. I can't go into the unsecured markets anymore after August 9, 2007 and borrow in, say, federal funds or in Eurodollar deposits or something like that, because credit risk and counterparty risk is rising there. And there's any number, derivatives, currency swaps, all these things become sort of self-reinforcing, so that at the core level, you're stuck with an unfunded asset that you have to either find some way to fund as all the rest of the system is breaking down and cutting you off, or you have to start fire sailing the assets. And once you start fire sailing the assets, that then produces all sorts of knock-on effects, especially in these markets for crap mortgage bonds and other crap securities, where that creates price effects, lack of liquidity, that then spreads all throughout the system, so that everybody who has been pledging these crap mortgage bonds as the basis for these multi-leg transactions, it all falls apart for everybody. And of course, dealers, rather than stepping in like they're supposed to, because they're a part of the system too, they're engaged in all of these activities too, they continue to pull themselves back at the worst possible time, so that it just becomes a vicious cycle, a self-reinforcing spiral where nobody has the right amount of collateral, nobody has the right kind of collateral, you can't get the derivative and risk layoffs that you want, and it just sort of falls in on itself.
You've touched on a couple of points that I wanted to raise, particularly when it pertains to the choke points of the system. And obviously, we're talking about this periphery system of the Eurodollar. But you've tied it back to repo, and you've mentioned pristine collateral, which is obviously sort of the main avenue through which all of this plumbing happens and the flow of capital can occur. We can fast forward a decade after the great financial crisis, right? History doesn't repeat itself, but man always does. And in 2019, we had this October 2019 repo rate spike, right? And now we're not talking about the Eurodollar periphery. We're actually talking about the core system within the US. I wonder if you might talk a little bit about how that happened and what we might expect, given that it doesn't seem like a lot of these issues were addressed.